Yeah, I kind of stumbled on it a couple years ago when I was actually working on a property in Alberta. I was doing a property in Red Deer where I have some of my portfolio. And the idea was, because I'm a contractor, I was doing a lot of work on my properties, which I loved at the time, and it was, but the problem is that I was, sort of doing that, flip to yourself or the Burr method where I was buying a property, renovating it, tenanting it, and then refinancing it. But I wasn't able to always pull out all my capital. I was always leaving some money in the deal. And I also was not getting paid for my time, essentially, because although I was able to save significant amounts of money by doing a lot of the work myself or general contracting it or whatever, the problem is that A, I wasn't getting paid for my time, and B, I was still leaving money in the transaction. So I kind of, wanted to look at something else. And I came across this idea of, what if I did all of the things that I normally do? So buy the property, renovate it, get it, legally, suited, put tenants in place, and then sell it to a joint venture partner, bring them in later in the process, and then retain a portion of ownership. But ultimately, then I got to get paid for my time, getting paid as flipping the property essentially, and then also got to own a portion of the property moving forward and got to sell a turnkey property to another investor, which was, really nice for them to be able to go to the bank and apply for financing in that point, because it was essentially, instead of going to the bank early on in the process saying, well, I think the property is going to be worth this much money. I think it's going to rent out for this much money, and I think the renovation is going to cost this much money. My joint venture partner is going to the bank already and saying, we know what the property's worth. We just had an appraisal done. Here's the revenue that it's bringing in every single month, and here's the operating expenses because it's been, up and running already for a little while. So it was nice for me because I got to sort of exit all my capital and actually get paid for my time. I gave up a portion of ownership, which I'm okay to do. I'd rather have, more properties and less ownership. And my partner got a turnkey transaction that essentially they got to come in after, all the inherent risk was sort of taken care of.
So most people in that scenario, and maybe some of the first few that you were talking about, you did it this way, where, you bought the property, you renovated it, and then you sold it. Potentially. That's where most people kind of end that transaction. They just sell it to somebody completely. They're out 100%. They lose all ownership. Yes, they get paid. But in this scenario, what you're saying is you're essentially still selling it, but you're keeping a percentage of equity. You still have ownership, even though you've received all of those funds. Is that correct?
Yeah. So, I had to talk with my accountant, my lawyer, make sure that I could do this legally. But essentially, the idea was, like we drop a purchase and sale agreement, and in a couple of cases, I've actually elevated the price slightly. And because we have a purchase and sale agreement, when the bank looks at it, it looks like, okay, Darren Voros or my corporation is selling to somebody else. And so there's no question generally around the value of the property there, as long as the appraisal comes in and says it's worth what you said it's worth. What I've done in some situations is I've agreed with my partner on the side that I'll do a cash back on closing. So we elevate the price just a little bit. Maybe I give them $10, $15, $20, $25,000 as a cash back on closing as an incentive to sort of lower their down payment. And also, just as sort of a nice thing to do for my partners.
Awesome.
And as long as your appraisal comes in.
Yeah.
For that, you can do that. Yeah. So guys, let's break this down a little bit too. Tina, you're asking, do they come in at 50%? So Darren, they come in at a 50% ownership, or do you give up more than that when they come in after?
It depends on the partner and it depends on the transaction. I think when I'm teaching this, I say like, if this is your first or second transaction, you may ask for 50-50 and somebody might come back and say, I don't think so. It's, I'm putting up all the capital. I'm holding the financing. The conversation with your joint venture partners. How well can you sell yourself as a working partner is something as maybe a different conversation for another day. But even if it's, your second or third property, and you can own a 30% ownership or a 40% ownership stake, I'd rather have that than essentially sell the property to somebody else, make some quick cash, and have no ownership moving forward. I'd rather own 40% of something than 100% of nothing. Yeah. And so, yes, I'm predominantly getting 50-50 now, but when I first started this, I was okay with, a 30-70 split for my money partner or a 40-60, because ultimately, remember, I have $0 into the transaction at this point. I've actually gotten paid for my time, and it's my joint venture partner that's putting up financing. So if I have zero money in, my return is infinite anyway.
So, and actually, just sorry, before you go on to your next point, I just wanted to touch on that one point that you made there, Darren, which was at the beginning, it's worth it sometimes to take less than that 50%. If you can start to do this 1, 2, 3, 4 times and get some properties under your belt, if you've never done one before, for some of those that are newer and watching or listening, if it's okay to take less than that 50%, it gets you going. I remember one of the first ones that one of the first JV partners we brought on, we accepted 2/3, 1/3. So we got 34%, but we ended up buying 17 plus properties with this guy in a 6-month period. So that upped our credibility dramatically. And so I just wanted to make that point, because you mentioned it, and it fits really good, especially for those that are just getting going, that sometimes you don't have to get that full 50% when you first start out.
No, and I think that, the larger transactions, multi-unit buildings, for instance, general partners, limited partners, it's rarely a 50-50 split, when you look at it from that perspective, because on a large multifamily, if you're raising $2 million, your investors are coming in with $2 million in capital. You're coming to the table with maybe some sweat equity, that kind of thing. Don't get me wrong. As a working partner, you're doing a lot in that transaction, but in that scenario, that's common for 30-70 split for working partner, money partner. So why would that be any different on a smaller scale? And I try not to get hung up on that stuff. Make sure that you market your value as a working partner. The thing that I always say to people is like, look, I went and found the property. It's my team in place. I did the renovation. I went through all the legalities with the municipality. Like, it's easy to sell what I've done. And it's also easy to sort of pitch, if you will, my 50-50 ownership moving forward. And I also am very clear with my joint venture partners that, look, your initial capital is paid back to you first when we exit this transaction. So when we exit, you're paid back first, and then profits are split 50-50. So it's in my best interest as your joint venture working partner to make this a profitable transaction, because if you get paid back your money first and there's nothing left over, I've now worked for free for 5 years or whatever that term is. And so that's another thing that you just want to make crystal clear with your joint venture partners as to why you're taking that 50-50 split. And the last thing I'll say there is, I'm 50-50 on cash calls too, right? So it's not just all the money that we're going to make. If there's money to put in, I'm putting in money from that moment forward too.
And that's a great point to bring out right from the very beginning when you're trying to sell yourself to a potential partner, that, you're in it as well for 50% of any losses. You're in it for 50% of any gains, so, and the fact that you, like you mentioned, you have a vested interest in making sure that this property performs really, really well, because otherwise you don't get paid for all the work you're putting in.
So I was just going to say, so let's just kind of break this down a little bit, just really simply. So let's say that you normally would buy a property, and let's just use simple numbers. So $300,000, you then renovate it, let's say with a joint venture partner, you then renovate it and pull out money, you split that, right? Plus you're probably expected to do some of the work, not free, but kind of free, right? So the difference is that if you just do the renovation yourself, you're pocketing all of the profits from your flip. They're not even involved until after. And then you refinance, and you're also pocketing, instead of splitting that with a joint venture partner. Again, you're pocketing your refinance money, which again, that's more money in your pocket to go buy more on your own. And then when you bring in a joint venture partner, you're also generally, since we can only mortgage up to 80%, generally, there's usually our down payment still stuck in the property. Now you bring in a joint venture partner and you get that 20%, your down payment out. You've now gotten paid 3 times, which is 2 more times than you would have if you brought in a joint venture partner from the very beginning, correct?
Yeah. And the other part of that too is it's actually less capital for my joint venture partners the later they get into the transaction. So to use your numbers, Tiff, that you were talking about, let's say we go in and we buy a property together from the beginning. We're joint venture partners, $300,000, right? Joint venture partner, let's say they're going to contribute capital. That's $60,000 for the down payment. let's say it's 65 with closing costs and all that kind of stuff as a joint venture partner, let's say in Alberta, where there's not a lot of land transfer and all that kind of stuff. Now we're going to finance the renovation. Let's say I've agreed with my joint venture partner that I'm going to be the contractor, but they're going to put up all the capital. So now they're another $50,000, $60,000 to put a legal basement apartment. Now they're in for, $115,000, right? So we refinance. Maybe the property's worth 400. Let's say that, right? That's like good scenario that it's worth $100,000 more. So we're able to refinance at 320, right? And so we're paying back a portion of that, but they've still got about $85,000 in that transaction, as opposed to if they come in later on in the transaction, right? Let's say they come in at the end. Now they're just putting up the 20% down payment. That's a significantly different amount of money than it is if we're trying to go through that process and trying to do that all from the get-go. And it's also now, as you know, the banks are getting more and more strict, like within that 1 year period, right? They don't want to see a lot of refinances done within that one year period. So if I can buy it first and figure out private financing on my side, and I can go into the transaction and I can sell it, then we can do that within 2 months, 3 months, whatever. We're not restricted by that 1 year refinance that the major lenders are now often putting on us as investors.
In this scenario, you bought it, you've renovated it. Do you then refinance it, or do you have your JV partner put a new mortgage on it?
So I would have my joint venture partner hold the mortgage. So I initially purchase it, right? Yeah. So that can be with a mortgage. I've done this with B lenders. I've done it with private lending money, whatever it is that I need to do to be able to acquire the property and then finance the renovation. So okay. I do that as an individual or through my corporation. Okay. Then once I've got everything, renovated, legally suited, tenanted, now I sell it to my joint venture partner. Okay. My joint venture partner has a purchase and sale agreement that they go to the lender and say, I want financing on this turnkey investment. And we have a bear trust agreement. We have a joint venture agreement in the background. And then I have a bear trust agreement with the CRA that says, I still own a portion of this property, so I don't have to pay capital gains on the increased value when we go to do that. But my joint venture partner is holding the title and holding all of the money into the transaction.
That's okay, cool. I like the bear trust bit with the CRA bit.
That's a big one. Yeah.
Right? Yeah. That's amazing.
One of the questions Raymond asked, are you able to avoid the land transfer tax in the sale to the JV investor?
Okay, so before you go into that, let me just tell you this, guys. This is a good guy to ask, because Darren, he knows the Alberta market good because he's an investor, started investing born and raised in Alberta, but he now has, rejected us and moved on out to in Toronto area and that does a lot of investing in that area. So you're a good guy to ask, even though you left us.
Hey, once you're an Alberta boy, you're always an Alberta boy. There's no getting around that. That's a great question. Land transfer, absolutely, you cannot avoid it. I pay land transfer when I acquire the property. So if this is in Ontario, for sure, or any other province that has land transfer tax, I'm paying the land transfer when I acquire it. When I sell it to my joint venture partner, then that's a sale, and there is a trigger of land transfer tax there. Yeah.
And so Tina asked, she asked if you stay on title, but since your JV partner is the one that's qualifying for the mortgage, they're the ones on title. So your interest is secured by a JV agreement, I would imagine. And you registered that on title. Is that what you've been doing?
I haven't been. My lawyers are sort of advising me that as long as the joint venture agreements are signed and everything's done properly, I mean, it's an extra added layer of protection if you want to. Yeah. This is where we just flirt with that line, right? Of like, you have to be really careful when you disclose things, when you drop your joint venture agreements. I tend to draw them up after the property has actually closed. Because there is a stipulation in the mortgage, most mortgage agreements that says, is there beneficial interest in this property? It's just one of those, like, it's an anti-terrorism clause, but it's for money laundering essentially, which is of course not what we're doing as real estate investors. But from the legal standpoint, when they're looking at that, they're saying like, okay, if there is a beneficial interest, which is why I always do this after the fact, and with my joint venture partners, we draw those agreements up. So we're not, in a situation where we're doing anything illegal.
Is it realistic to assume the ownership split would also depend on how good the deal is? So the better the deal, the easier it is to get a higher percentage.
I think that, and you guys will know this better than anybody. You've done this so many times and you're the pros here, is like, people aren't investing in the deal per se. They're investing investing with you, so if they trust you, if they think that it's a good opportunity, then, it's open for negotiation. But I think the better the return, if it's like, if I'm going to say my joint venture partners are going to make an 80% return, I'm not asking for a 75-25 split in that way. I think that this is a business that is based on repeat business, right? So it's like, I'd rather have a 50-50 split, give my joint venture partners an amazing experience, because guess what? What are they going to do? They're either going to do another transaction with me, or another 17 in your case, or they're going to recommend me to somebody else, a money partner. And if you're a working partner, if you're a joint venture working partner, this is the hardest part of this whole transaction that I just said, because I know the question's going to come in. Well, where do I find these partners that are willing to do this, right? And that's just all around marketing and all around word of mouth and all around your reputation.
Yeah, absolutely. And even getting people to then, that you have partnered with, they've liked you, they found you fair, trustworthy, and all that, and they start bringing people to you. But it's getting those first few that really, the hard part.
And really good point about making a big win for your joint venture partners. If you make a big win for them, they're going to just reinvest with you again, and they're going to want to do it again and again and again. And in our case, some of our joint venture partners brought other people to us. They brought us other joint venture partners because they were telling all their friends and family about how things were working out for them. So excellent point there. You want to make sure it's a win for them, number one. And if they're winning, then usually you are, right?
Another little thing that, I'm in a position where I'm not able to qualify generally for financing at this point, just because of the amount of mortgages I hold. But if you are in a position where you could still hold the title on that property, somebody could come in with RSP money or TFSA money, right, and secure against the property, which may be another selling point to a joint venture partner to say, look, if you can hold the financing in maybe in your personal name or in your corporation, and they can come in and just do a second lien against the property with an RSP position, then that might be another opportunity to look at another way to structure the deal. I know I just opened up another whole can of worms. But sorry.
I was going to say something about it earlier, and I thought, no, I'll leave it because I don't know if it's kind of worms, but since you did. But that would probably, and you can correct me because land transfer, I do not, but that would then avoid the land transfer at that time, right?
Yeah.
At that, because you're not changing title at that point.
Correct. Yeah.
So Ray asks, any concerns about not being able to find the partner once you've got the property under contract, or do you always line up a partner first for this strategy?
Yeah, this is a question I probably get more often than not on this strategy, is when do I figure out my partnership? And it's, I think that it's really a matter of how much experience you have and what your network is like. Because if I was just starting out with this, I'd kind of want to know that I have somebody to pass this property off to, or at least I'd want to know that I could carry it moving forward on my own terms. Like you guys, I like to have multiple exit strategies on every single property that I get into. So if my one exit strategy is I have to find a partner and I have to sell this to them in order to make this property a go, the desperation comes across in the joint venture sort of conversations, and I never like to be in that position. I always want to have people sort of coming to me. So now I'm okay. I'm okay acquiring a property without having a joint venture partner there to step in. But it's also because I know that sort of my network of investors is going to potentially scoop that up when the opportunity is there. But when you first get into it, I'd say make sure you have the partner at least lined up. And I'd say have 2 to 3 partners lined up, because you'd be amazed what happens with people with cold feet, 3 months down the line when you're ready to sell to them, and all of a sudden they've changed their minds.
Yeah, for sure. And that, your point about having, people that are just getting started in this, and for those of you that are watching that, haven't done it yet, it's amazing how later on, once you've done a couple of these things, people start, it's like finding the money partners doesn't become the biggest issue. It's finding a good deal, or it's doing those sorts of things. But I remember when we first started, it took us a while to get that first one. Took us a while to get that second one, but then the joint venture partners started lining up. And when we had opportunities, we were sending it out to 10, 15, 20, 25 different people at a time. And it was like first come, first serve. And people were just kind of like, I want that opportunity. I want that opportunity. So things change as you go along in this business for sure.
So what's your opinion on looking at securing properties that you know can either be subdivided or redeveloped according to their current and future designated zoning? This gives you an even greater buy and hold value. Yeah. So what do you think about doing that with a subdividable piece of land and or property?
It depends what your timeline is. And I think it depends on how much appetite you have to sort of deal with those situations where you're subdividing a lot, what the opportunity is. I learned early on in real estate investing to take the path of least resistance. In order to find the highest return. So if that's something that you feel super comfortable with, I would say go for it. Obviously, if I could take a lot here in Toronto and subdivide it and build something else, the returns would be astronomical. What that process looks like, what the capital outlay is, what happens if you can't subdivide it, all those things would come up for me. And real estate investing has always been just very simple in terms of, risk reward, how much money do you have to put in, how much possibility is there, and what can I potentially pull out of that if things go well. So for me, my decisions are very emotionless at this point. They're just very based on the numbers and the strategies and the things that I feel comfortable that I can get done. So that wouldn't be something that I would look at without having experience. And I don't have any, relevant experience there. I often take properties and change the use of them, right? From a single family dwelling to a fourplex, fiveplex, whatever that is, but it's all in the zoning parameters. So I'm not actually taking something and changing the zoning. I'm just changing the use, which is a very different application than changing the actual zoning or subdividing a lot. But I know people do it. I knew they do great at it. So if it's something you're interested, I'd say, do your due diligence and go for it.
Along the same lines, people ask us, well, how come you never got into multifamily, or have you ever done any commercial or industrial type properties? And, for us, we felt so comfortable and we kind of felt like we mastered the residential investment properties that it was like, this just became cookie cutter, and it's one to the next, to the next, to the next, to the next. And yeah, there's other things we could learn, and we could get into the multifamily world. We could get into those kinds of worlds. But for us, we just felt comfortable sticking in our own world that we knew really, really well. And we just kept doing the same thing over and over again. So like you said, and lots of people in here have lots of different strategies, and there's different ways of doing so many different things. But you want to be comfortable with what you're doing as well. And if you find something that works, there's nothing wrong with sticking with that, right?
I think that some people, and I'll call them, novice investors for lack of a better term, but I think there seems to be this hierarchy in real estate investors that you have to start with singles and then duplexes and then triplexes and fourplexes and then go to the 10s and the 12s and the 20s. And then you have to eventually at some point get to 100-unit buildings. Well, that's not the path for everybody, and I would say that if there's something you're really good at, if that is like finding a single family dwelling, converting it, putting a basement apartment in, and finding a joint venture partner and repeating that process 100 times, like that's phenomenal. That's going to get you to where you want to be. I always say, like, find something that you like to do and that's going to work for your system. But do you need to go to multi-unit? No. Like, yes, it's something that I'm doing now because I really have a passion for it, but it's not something that you need to do as an investor. It's not, you don't, there's no gold star that they hand out to you when you get your first multi-unit property if you've got 20 other, properties underneath your belt. It just doesn't work that way.
Darren, do you use a second lawyer for the JV and closing? Would it be a conflict for you to use the same lawyer that you used for your closing?
Great question. I've had this actually happen to me before. We had our joint venture partners ready to go on a transaction in Red Deer, Alberta. And our lawyer here in Toronto drew up our joint venture agreement. Everything was great. And then we sent him the closing documents and he was like, guys, I cannot, sign these for you because, like I say, that clause in there that says there's a beneficial interest on this property. So he said, here's my advice to you. Here's my legal advice to you. Get this signed with another lawyer. get the mortgage documents signed off, everything like that. Come back and see, do you guys trust this relationship? And for me, if I'm joint venture partnering with somebody, I'm okay not to have a joint venture agreement on day one. I would never partner with somebody if I don't feel comfortable enough to say, yeah, let's let a month go by and then we'll drop that joint venture agreement after the fact. That's what was his legal advice. Said, get it done with another lawyer, then come back to me a month after we've closed the transaction. Then we'll drop the joint venture agreement because now there's no conflict and now everything's above board. So to answer your question, yes, you got to be a little cautious about that. We actually just ran into it on a refinance too. I was refinancing a property and it was the same situation. My Red Deer lawyer was dealing with both the refinance and we were buying out a partner. And so my partner didn't know any better and he just sent him our joint venture agreement. And then the lawyer was like, what's going on here? There's a beneficial interest. How does this work? And so we had to sort of like go back to the lender again and disclose everything. And it was like a little bit of a headache, but always stay above board for sure. You want to make sure that you're always doing things legally, ethically, especially when it comes to mortgages and all of that, because you never want to be in a situation where you're crossing that line.
So Julie asked a good question. What strategies do you use to find low-priced properties? Is there anything in particular that stands out for you, Darren?
I think for me, it's always a matter of I'm not so concerned about finding low prices right from the get-go. I think like the couple of properties that I've done this on in Hamilton and Toronto and in Alberta, I like to tie up the property first. And then I like to do my due diligence, and then I like to be able to negotiate a little bit. Now in Toronto, over the last couple of years, been a situation where it's just been almost impossible to have any kind of conditions on offers. And so to me, as a real estate investor, unless I know it's a home run, I'm not willing to bid on a property. It's not what I want to do. So I'm trying to find, private opportunities in that scenario. In Alberta, I'm putting offers in on properties. And I'm doing my best to negotiate right from the get-go. And then I hire a home inspector. And once my home inspector comes back, then I start to negotiate a little bit, because guess what? The sellers already have taken that property off the market from everybody else, right? So, and the last thing that the seller wants is for them to have to put that property back on the market, because that just has a whole bunch of other questions, right? Why did the deal not happen? And it doesn't matter what the reasoning was, but it's always as a buyer. And I know that people have probably been in this situation. When you see a property come back on the market, what's your first thought? It's like, oh, what's wrong with this property, right? So for me, I tie it up, I do my due diligence, and then I negotiate after the home inspection or whatever. I try to get another, $5,000, $10,000, $15,000 off the purchase price at that point. But it's a little bit easier. And the way that I do that is I say, look, we're ready to sign on the dotted line. This is going to be a done deal. I just need you to give us this $8,000 reduction because of X, Y, and Z that the home inspector turned up. But other than that, we're ready to go. It's the best negotiating thing, because people know, they're like, okay, let's just get this deal done, sign on the dotted line, and away we go. Right?
And it's interesting the point that you made, because just recently, like I think within the last month, there was new legislation here in Alberta, and I don't know if it affects everywhere else, but here in Alberta, where if a property does go pending on MLS, it has to be marked on MLS as pending within 24 hours, which it never had to before. And in fact, you never even had to. There was no reason that a realtor had to put it as pending unless they just wanted the phone calls to stop. But now they have to mark it as pending. So, if it does go pending and then it comes back on, you're going to see a lot more of that happening now, because that regulation has gone into effect. So, or legislation has gone into effect. So anyways, yeah, good point. You can, and that's the thing, until conditions are removed, it's not a done deal. It's never a done deal. If you're a seller and there's conditions, it's not sold yet. It's just pending. And if you're a buyer and you have conditions, same thing. You haven't bought it yet until those conditions are removed. So up until that point, there's absolutely room for negotiations.
What are the typical numbers in this strategy? Purchase price to ARV and renos to get there.
Yeah, I can run you through one we're doing right now in Hamilton.
Fantastic. I'll write it down, and then that'll kind of help everybody to see how it all works.
Yeah. So we bought it for $425,000. I bought it privately. Bought it from a wholesaler. And so I came up with, we got private money, essentially 50% loan to value, If you really want to go into the details, we paid a 2% lender fee. We're paying about 8% interest on the 50% of the money that we bring to the transaction. I bring the rest in terms of capital from a line of credit that I have, blah, 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 blah. Anyway,
So just before we go any further, you said that you bought it from a wholesaler. So did you pay an assignment fee as well?
Yeah, I did.
Okay. You know what? That's funny because we made assignment fees. We sold a ton of assignments when we were really active doing that. But we also paid assignment fees. And you know what? If the property is good, and that goes back to what you were talking about earlier, if the property is a good property and it's worth it to pay that assignment fee, then it's still worth it to go ahead, right? So, so yeah, even though sometimes we cringe at doing it,
if we're gonna make money off of doing it, we can pay money to make money.
Yeah,
it's okay.
Yeah, I'm okay with that.
Okay, sorry, I cut you off with that one.
No, it's all good. So $425 was the purchase price, and essentially we paid closing costs, legal costs, and line transfer, all that kind of stuff for about I don't know, $12,000, something like that. Reno is going to be about $80,000. So this is a legal basement apartment, doing some cosmetic upgrades upstairs, removing all the sort of interior walls on the main floor to make it open concept. We're adding a half bath on the second story. And this is actually one of the first projects that I'm doing that I'm not actually doing any of the work. And it's really, really hard for me because I'm working now on my business and not in it, which is a thing that I've learned as an investor. But I have somebody on the ground in Hamilton that is managing things, because even though it's 45 minutes away, I do not want to be driving there every day to sort of check in on progress. So we're about $80,000 on the renovation. Private financing, we're in for about 15, let's say. So I think that adds all up to about 540,000, something like that. Is that right?
Yeah, I think $532,000. 532 is what I got. Okay, Darren. So you're at 532 after the reno, after your financing cost, after your closing costs, and your purchase price. You're at roughly 532. Okay. Mm-hmm. So where do we go from there?
So essentially, after we've completed the renovation on the basement suite, everything's legal, everything's closed off on the permit side, we've put tenants in place. This property will generate around $3,200 to $3,400 on a monthly basis. It's not crazy cash flow on this property, but I've owned some other properties in Hamilton that have just been doing very well in terms of year over year increase. I never like to count on that, but it's just been the fundamentals here in the greater Toronto area and the Golden Horseshoe are pretty solid, right? So I'm pretty confident in that. But I think it's cash flowing $400 or $500 a month, which is great. It's still doing well, but it's not a couple thousand like some of my stuff in Toronto is. But essentially, we'll sell it to the joint venture partner for somewhere around the $600,000 range, right? I mean, we'll figure that out as we get closer to that date. But we'll sell it to the joint venture partner for around $600,000. So they'll come in, put up the financing, do all that kind of stuff. They'll qualify for the mortgage. They'll put up the down payment. They'll pay the land transfer. And we'll give them a cash back on closing. I'm looking at somewhere between a $10,000 and $15,000 cash back on closing on this one. So the reason I do that is because essentially there's no other way to get, everyone knows that there's no other way to get, your loan to values to be like, 85 sort of percent in a conventional mortgage situation. But it's nice for my joint venture partners that I can say, you're going to pay $600,000 for this property on paper, but I'm going to hand you back $10,000 or $15,000 on closing as sort of an opportunity cost to be working on this transaction. So it's good for me. I still make my split on the flip side, right? 530 to even if it's 585, something like that. And I have a joint venture partner on the actual initial transaction who's managing all the day-to-day operations in Hamilton, but we still make our money that we were going to make on the flip. But then I own a portion of it moving forward with my joint venture partner in that price range.
So really for your JV partner in this scenario, they are qualifying at a $600K value. there it means they're putting 120,000 cash in, but if they're getting, let's say, 15,000 cash back, they're really into this property for 105,000 is what they have to input plus qualifying for a mortgage. And they're getting a cash flowing property that's fully renovated, has a legal suite in a great location. So you can see why it sells to a potential partner. They don't have to do any of that work. You're supplying all of that. You're going to be managing it, taking care of it. The tenants are in place, all of that good stuff. And they walk in and get in for a low or a high leveraged amount. Really, they're putting less than 20% down to get into a property like this. So that's really how the numbers work. So hopefully that made sense for everybody.
Yeah,
that's awesome. You can see how that's a win for you, Darren, and you can see how that's a win for a potential partner. Excellent strategy, combining more than one strategy together here. So I actually see several. When you bought it from a wholesaler who made an assignment fee. You're using private financing. You're here doing a renovation, and you're making a little bit off of the renovation potentially. And you're at the end of the day owning a great property and have a percentage of ownership after you've sold it and made a profit on it. So I see a lot of win there all around. So congratulations on putting all of that together.
Yeah, when I used to teach this when I was traveling across North America, I would sometimes bring this strategy up, and I would say it's not for the faint of heart. There's a lot of elements to it, but when you can master it, you can see I can reuse the same capital over and over and over and over again, right? So if you can do this properly, you can add properties to your portfolio without having to ever need additional capital if you can just keep finding joint venture partners. And just to add another sort of, because we talked about it earlier, this is something where I offered my joint venture partners a 40-60 split, right? I was like, okay, I'm okay with 40% ownership of this property moving forward. I have some other properties in Hamilton already, so I know that I can just add that to my portfolio. My property manager takes it on. It's easy for me. I'm fine to give up 60% ownership on this one to be able to have that. And it's trying times in a way, right? So you want to incentivize the deal a little bit to say, like, here's the opportunity. I could go in at 50-50 and potentially go a little bit harder on my negotiations, but this is something where you want to be able to be flexible in the current situation, because it is a bit of sort of unknown territory moving forward. But I think because I want to hold this property for the long term, I'm not worried about, if there's a short-term fluctuation in market value, and neither is my joint venture partner in this situation. They're like, great, okay, we're holding this property for 5, 10, 15 years. We're solid on the prospects of what's moving forward.
At what point during this process are you looking for a JV partner to sell to? So, did you have that person in mind at the very beginning, or is this, at what point do you start giving this as an option to potential partners?
So this is why I said earlier that you want to have multiple partners lined up, because my first partners are friends of mine that I know from the Ottawa area, and they were ready to go. This was a property they were interested in. And then all of a sudden, their mom got an eviction notice of the place that they were living in. They've got now this capital they wanted to invest. And they're saying, you know what, we're actually looking at buying a property in Ottawa now because we'd love to have our mom help her out. And so things change, right? So that's why I have a couple of people in line basically saying, like, if this is my obviously my friends have first right of refusal, but if they're not going to move forward on it, then I've got somebody else waiting in the wings to be able to step in. It's that dance, right? Between like what comes, it's kind of like the chicken or the egg thing. Do you find the property and the opportunity before you find the joint venture partner, or do you find the joint venture partners and then sort of find the opportunity? I would say if you're starting out, I would say find the joint venture partners and secure them first, and then find the opportunity. Discuss the numbers. Say, you guys, you teach this all the time. It's like, what is the sort of the price range you're interested in? What is the kind of capital you're interested in contributing? I'm not asking them to commit to a certain number, but I'm saying, here's a property that we just did in this price range. Is this something that would work for you? And without them saying, yeah, I've got $150,000 and I can qualify for a $600,000 mortgage, they're saying, yeah, I could do one of those, or if things go well, I could maybe do 2 or 3 of them. Well, for me, I don't have to ask the question of how much money they have or how much qualifying power they have. I can just show them a deal that I've done in the past and say, is this something that's interesting to you? And they can either say yes or no. They say, that's a little bit over my head. Well, then I can say, okay, great. I've got some other opportunities in Alberta. Maybe that's more of a price point that makes sense for you, without actually having to discuss numbers and dollars, because I know some people are uncomfortable with that on both sides, the joint venture side and the money side.
Absolutely. We never want to come out and say, how much money do you have to invest with me?
Not
a question that we want to ask.
I'm amazed at how many people will say that to me, and I'm just like, really, like, wow.
I learned this from you guys, like I learned it from watching you guys on stage over the years, and just, you're so good at having these conversations, and it was something that I picked up from you, and it's been hugely helpful in everything that I've done in real estate investing.
Awesome. So thank you again. We'll be in touch. Hopefully you're going to kill it on this next deal you're doing and continue on from there. So we wish you all the best, and we'll talk again soon, Darren.
Thanks so much.